Welcome back to Ground Rules, where we unpack the stories behind the numbers and help you stay ahead of the markets shaping South African agriculture. Last week, grain prices surged, only to fall sharply again on Monday. So what happened? Was the rally simply driven by short-term events, or are markets already beginning to price in potential grain shortages for next season? We'll answer that and much more in today's episode. But before we dive in, we are excited to share that Ground Rules has partnered AMT to bring South Africa's trusted agricultural market intelligence to an even wider audience. While AMT continues delivering its renowned market update in Afrikaans, Ground Rules is proud to bring you the English edition, drawing on the same trusted AMT data and insight that producers across the country have relied on for years. Now, let's get into this week's grain market update. Here's where the major grain markets are trading this week. White maize sells sharply at the start of the week, with the spot price easing to 3,484 Rand per ton, while the July 2027 contract declined to 3,831 Rand per ton. Yellow maize also weakened, trading at 3,538 Rand per ton, with the July 2027 contract slipping to 3,760 Rand per ton. Soybeans experienced a significant pullback on Monday, with the spot price falling to 7,895 Rand per ton, with May 2027 contract trading at 7,910 Rand per ton. Sunflower seed prices eased to 9,906 Rand per ton, May 2027 contract at 9,077 Rand per ton. Wheat remained relatively firm, with spot costs at 6,240 Rand per ton, and December contract trading at 6,140 Rand per ton. Elsewhere in the market, sorghum import parity landed in Durban stands at 4,553 Rand per ton. Argentine shelf groundnuts have an export parity cost of 20,928 Rand per ton at Grandpuntee. Cotton continues to trade at elevated levels, averaging 11,350 Rand per ton. So what really moved the grain market? Last week's rally had many people believing grain prices had finally entered a long-term upward trend, one that they can continue into next year and finally, after some producers much needed margin relief. But if you watch last week's Ground Rules update, you'll remember we suggested something slightly different. We believe the rally presented an excellent opportunity to market old season maize and soybeans. Why? Because those crops were produced before the fertilizer price spiked following the conflict involving in one. So selling at a higher price has significantly improved profit margins for all milling producers. And then Monday happened. Why did prices fall? Oil prices dropped by more than 5% after the United States and Iran temporarily halted military action. Almost overnight, part of the geopolitical risk premium disappeared from both the grain and the oil markets. That tells us something fitted. Much of last week's rally wasn't driven purely by supply and demand. It was fueled by a combination of the hotter and drier US weather forecasts, escalating geopolitical tensions, greater uncertainty around Black Sea grain exports, renewed Chinese purchases of US soybeans. So when all those factors align, the markets can rally quickly. But even when one or two begin to fade, the prices can retreat just as fast. Looking over at wheat remained one of the strongest performing commodities last. Prices climbed on concerns surrounding the Russia-Ukraine conflict, the uncertainty over exports from the Black Sea region, and increasingly dry conditions across parts of Europe, the United States, as well as Australia. That strength also helped support maize and soybean prices. However, it is important to keep the bigger picture in mind. The United States is still on track for what could be another very large maize and soybean harvest. According to the latest crop reports from the US, 67% of the US maize crop is rated good to excellent. 66% of the soybean crop is also rated good to excellent. Soybean plantings are 5% larger than last year. Yes, some regions may remain hot and dry, But at this stage, there is no evidence of widespread crop failure. Those healthy crop conditions and expectations of larger global supplies are taking some of the momentum out of the market. But that doesn't mean the story is over. No, we are still far from it. July still remains one of the critical months for maize development, while August is the most important period for soybeans. There is still plenty of time for weather to influence production. And that is exactly why the global markets remain extremely sensitive to renewed forecasts. Why is fund activity so important? One development worth watching over the next few months is the behavior of investment funds. Funds have rapidly rebuilt large bullish or long positions in grain market. That shows confidence has returned, but it also creates risk. If US weather improves, if geopolitical tension eases further, or if Chinese buying slows, those same investors could quickly begin selling, and that could then place renewed downward pressure on prices. China's buying matters, but don't read too much into it yet. We have recently seen that China has returned to the US soybean market with several significant purchases during July. That's certainly positive news, but it's still too early to conclude that China has permanently shifted back to buying large volumes from the United States. The market will be watching closely over the coming weeks. Another important event on the horizon will be the expected meeting between President Trump and President Xi in September, which could influence future trade flows. Now, looking beyond this season, even with recent price weakness, it's unlikely the market won't simply collapse. The reason being, the traders are already looking beyond this season's pops. Attention is beginning to shift toward next season and the possibility of tighter global spikes. One major reason is El Nino. This is no longer just a possibility. The U.S. National Oceanic and Atmospheric Administration, NOAA, has issued an El Nino watch, expecting the event to strengthen during the remainder of the year, with a 97% probability that conditions will persist into early 2027. That doesn't automatically mean widespread drought, but it does significantly increase production risk for the next growing season. At the same time, global demand for maize, wheat, and oilseeds remain robust. If South Africa or major producers like Brazil experience lower production next season, even a relatively small reduction in supply could trigger a sharp upward price response. That should provide some underlying support for grain market over the medium term. So, back home, South Africa has already exported more than 800,000 tons of maize, making good progress in reducing the large surpluses built up over the past 2 seasons. For all-season grain, the strategy remains unchanged. Take advantage of price rallies whenever opportunities arrive, particularly if you do not have long-term storage available. Clear all-season commitments while favorable prices are available. The outlook for the new season, however, is quite different. We've got higher input costs, a strengthening El Nino, and strong global demand. All these suggest that there is meaningful upside potential if production disappoints next year. Remember, it doesn't take a massive supply shortfall to move grain prices sharply higher. Sometimes even a relatively small reduction in production can trigger a significant market reaction. So, what are this week's ground rules? Last week's rally reminded us just how quickly grain markets can move when weather, geopolitics, and global demand all align. But this week's correction is an equally important reminder not to mistake a short-term rally for a long-term trend. For producers, all-season grain should still be managed strategically whenever opportunities for better pricing arise. For the new season, the focus should already be shifting toward managing production risk rather than chasing today's market. Higher fertilizer costs, a strengthening El Nino, and resilient global demand all point to a market where preparation will matter more than prediction. Thank you for joining us for yet another Ground Rules Grain Market Update. If you found today's update valuable, subscribe to the channel, share it with someone in agriculture, and join us again next week as we unpack the trends shaping South Africa's grain market. Until next time, remember our ground rules. Markets reward those who stay informed, but they reward those who plan ahead even more. So, the best decisions are grounded on some solid ground rules. See you next time.